We're at a phase now where I think silver has likely, when this spread breaks out, to go up to 100, at least more likely closer to 200 within a couple quarters. Gold will be going up during that time, but silver will just go vertical when this spread breaks out. Now, if you look at the chart below, this is what we do. We look at momentum and structure. The spread chart has two breakout levels, and the momentum chart also has two, except that the momentum chart's already broken out over its downtrend, okay, heads up, and then that peak that we made in September and downtick slightly in October on the black line on the bottom chart, we already hit that triple top structure. Downtick slightly, didn't get slammed.
Financial analyst Michael observes that silver is entering a critical phase in its long-term bull trend. According to his analysis, the spread between silver and gold is approaching a breakout point that historically precedes dramatic price appreciation. Oliver highlights that once this spread breaches key technical thresholds, silver has the potential to rise 100% to 200% within a few quarters, far outpacing gold, which is also expected to increase, but at a comparatively moderate pace. He emphasizes that these conditions are not speculative, but are grounded in decades of historical precedent and precise market structure analysis. Oliver further explains that momentum indicators already support this outlook, with the charts showing clear breakout signals over established downtrends. The triple top structures, observed in recent months, along with minor downticks, validate the strength of the ongoing trend rather than signaling a reversal. These technical confirmations indicate that the market is poised for a potentially vertical move in silver prices. Finally, Michael underscores the strategic significance for investors. The alignment of spread breakouts, momentum confirmations, and historical patterns suggests that silver could lead the next major phase in monetary metals. While gold will continue to appreciate, silver's relative undervaluation presents a unique opportunity for outsized returns. Oliver's detailed technical framework provides both confidence and clarity for market participants seeking exposure to precious metals during this pivotal period. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Yes, absolutely. Yeah. The spread relationship is sort of stunning. You look at the S&P, which has a beautiful structure. I mean, it'll explode when you get out of there, the gold relative to the S&P. But it's already broken out versus broad indices. And everybody knows right now that, yeah, the S&P and NASDAQ 100 are highly focused on just a few symbols. In fact, there's 5 or 6 symbols in the front end of NASDAQ 100. Remember, there's 100 symbols in it in the index. 5 or 6 symbols up front are 50% of the index. Why even call it an index? Just call it a call option on 5 stocks. But anyway, but everybody knows it's distorted, and they're scratching their head, and yet it doesn't seem to go down, so they've given up on that notion that you have a distorted situation, which is fine, because when it breaks, then they'll be surprised. You might have had some marginal indication there's decay, but the real pain to the average guy in the street did not occur until, let's say, 2008 and 9, for example. Unemployment, et cetera, homes lost, et cetera. This time we have a much bigger crisis because we have a government debt crisis, not just mortgages. Okay, we got Japan, U.S. There's others. It can't be printed away this time. And if they try to, which they will, print it away, monetary excess, what's the prime beneficiary of that? It's always been gold, monetary metals. And this time we happen to think silver is the one that will outpace gold starting very soon in a way that is likely to really shock people. I think we even have a chart of that in this report at page 10, I think it was. Yeah, there you go. If you can focus in on that a bit there. I don't know if you can or not. Yeah, the top chart, forget the bottom chart for the moment. Top chart is simply a spread chart. Again, divide the price of the front month silver into the front month gold, express it as a percent. And you can see this goes back to 2020, 5 years. And there was a low in early 2020 when the silver price was less than 1% the price of gold. And you exploded up out of that hole. That's when we had that sharp rally in gold and silver starting in March of 2020 through late summer, later that year anyway. 6 months of explosion in price. Well, during that time, silver really gained versus gold. It was the better place to be. But since that, in fact, that spread peaked in early 2021, since then, you can see that the spread, the black line, has zigzagged down. What does that mean? It means, yeah, silver was going up all during that time. We're way higher than we were in 2020. We were $30 then. We're now, either side of 50. But it was underperforming gold. So gold's done better over the last 5 years. But during that time, you can draw a couple lines on that top chart, the spread chart, technical line. There's the black downtrend, which you bumped a month ago, and then last month downticked ever so slightly from that line, thereby acknowledging the line as being valid. Okay? And then there's the red horizontal line above you on that spread chart, top, just above 1.3%, meaning divide silver into gold, 1.3%, you're bumping that line. Actually, 1.32%, and you break out over that base. That base goes back 3 years, so it's a wide base. Why is this spread important? If you go back into the 1979 surge in silver, silver had already been going up for years, just like gold. So they're both in bull trends, but silver was underperforming gold, much like this chart here. But in the summer of 79, 5 months before you peaked, the spread broke out, saying, okay, yep, I've been underperforming gold on the last couple of years, both going up, but silver just not going up as much. Silver said, I'm now going to perform gold. Silver went up 4.5 to 5-fold in 5 months. Went from like $15 to 50. Okay, in 5 months. So the bull trend went vertical. The same thing happened late in the bull trend in 2010 and 11. We know the monetary metals peaked in 2011 after having been going up for a decade. But I think it was September of 2010, again, you looked at the price charts, gold and silver just trekking up, fine, everything looked good. But silver broke out on a spread chart that looked fairly similar to this one. And it said in September 2010, okay, now I'm going to beat you, gold. And silver doubled in half in 6 months in net price. So that's why this spread is important, because it tells us that we're at a phase where silver, which is vastly undervalued to gold, historical measurements, going back 50 years, could zoom in relative performance and in net price. It is our argument, based on a lot of technicals we won't get into right now, but partly on the triggering of this spread, which you can see we're all about ready to break that black downtrend, and the red line above on the spread chart that's total break. We're at a phase now where I think silver has likely, when this spread breaks out, to go up to 100, at least more likely closer to 200 within a couple quarters. Gold will be going up during that time, but silver will just go vertical when this spread breaks out. Now, if you look at the chart below, this is what we do. We look at momentum and structure. The spread chart has 2 breakout levels, and the momentum chart also has 2, except that the momentum chart's already broken out over its downtrend, okay, heads up, and then that peak that we made in September and downtick slightly in October on the black line on the bottom chart, we already hit that triple top structure. Downtick slightly, didn't get slammed, very downtick. You close above that red line on the momentum chart, that spread chart will follow very quickly. So we're watching momentum as a leader. It almost always leads in this situation. So we have a situation here where we think silver is about to go vertical, but that is a signal that both monetary metals are about to go vertical, with silver in the lead. So this is what we're focused on right now.
Michael Oliver emphasizes that gold's relative performance against the S&P 500 has been building a strong technical foundation for over a decade, signaling a potential breakout that could redefine asset correlations. By examining the spread between monthly closes of gold and the S&P 500, expressed as a percentage, he highlights a massive base formation that has persisted since 2013. The current reading of approximately 58.5% sits just below the 60% breakout threshold, an event that would mark gold's dominance over equities. Oliver notes that this plateau indicates growing market tension, with gold ready to assert itself as a superior store of value amid increasing distortions in stock valuations and rising global debt burdens. Transitioning to silver, Michael Oliver underlines a historic setup echoing the monumental surges of 1979 and 2010. His analysis of the silver-to-gold spread reveals a nearing breakout above the 1.3% threshold, signaling silver's readiness to outperform gold dramatically. The chart's momentum indicators already confirm this shift, suggesting that once the spread breaches key technical levels, silver could rise by 100% to 200% within a few quarters. Oliver concludes that such a move would not occur in isolation. Rather, it would signal the vertical acceleration of both monetary metals, led by silver, as investors seek refuge from excessive monetary expansion and systemic instability.
If you go back and examine on a ratio scale chart, logarithmic chart, in other words, an 8-fold move occurred between 1970 6 low and the 1980 high. 3.5 years, 8-fold gain in gold. Okay. The next bull market started in 2001 and lasted till 2011. 8-fold move. We started from a low at 1,050. You do the math, okay? To even match those highs, gold would have to be over $8,000 just to say, oh, I'm doing it again. So keep that in mind. But there's other bigger things going on in the world, market-wise, stability-wise, and so forth, that can drive gold, I think, a lot higher this time. And this time, I think it's going to become institutionalized, and it ain't going to come back down. You may have some sell-offs and so forth, but I think it's going to be one country, another country, another country. Suddenly, gold is now money again, recognized. And I think that's where we're headed. That's right. What would cause that is not just a thought process, but pain, because that's what drives people to reject old prevailing ideas and go to some new idea. In this case, a resurrected idea that's already been there before for 3,000 years. Gold's been money, in a lot of places, including here, until Roosevelt and then Nixon got rid of that. I think we're headed there. And I think one of the factors that will help spark that sense of 52 card pickup, panic, is when you break the stock market. And I think it is in a topping process and has been since late last year. The S&P made a new high by 10% so far this year, above the early year highs. But many indexes and sectors did not. But anyway, I think we're topping in the stock market. When that breaks, that creates a movement of money out of a bursting asset into what is perceived to be, that's a better place to be. T-bonds aren't the alternative this time. In 2000 to 2002 and from 2007 to 2009, when the stock market went down, T-bonds went up in price, down in yield. So did gold. So they were both alternatives. This time around, T-bonds are sick. They're anemic. They can't get off the mat. And this leaves gold and monetary metals as the only real alternative. This chart you've got here was in our weekend report and some prior reports. It shows a spread relationship, what we call relative performance relation, between each monthly close in gold divided into the S&P 500, express that as a percent, and you plot it on this percent chart. This goes back to 2013, when gold was coming down, of course, from 2011 to 13. Well, so was its relative performance to the stock market. So therefore, you see a decline in the spread value. But then over the last 11 years, we plot a red line across each of the relative performance rally highs in gold measured against the S&P. And good grief, we have a 4-point line, almost flat. This is what you call a massive base. We hit it in April, backed off, didn't collapse this time. Unlike the prior hits up there at the red line, you went down, down, down. This time we went down for a couple of months. No, last month we closed right back below that line. You close out over that line, meaning if you get any month where you can divide the price of the near front month futures contract, presently that's the December gold, divide it into the S&P 500 cash, express it as a percent. If you get 60%, that's a breakout. We closed last month about 58.5%, right up against that line. Now this is, everybody says, well, we haven't broken out yet against the stock market. But you remember the S&P is a heavily distorted index. In fact, 5 of the front end stocks in that index are, they're all tech, okay? NVIDIA, Microsoft, Apple, and et cetera, et cetera. And they constitute 30% of the entire 500 stocks. Whereas 5 stocks have the weighting of 30% of what's an index involving 500 stocks. So it's heavily distorted. Okay. Flip the page and you'll see something interesting. Here we measure gold the same way back to 2013. But against the Dow Industrials, Dow 30, top chart. And the bottom chart is an index people seldom look at. That's the New York Composite Index, which is, huge quantity of stocks, but not distorted by front-end weighted symbols. It's more evenly spread among all the symbols. And we've broken out, because you've already broken out of the base, where you can say, okay, measured against broad stock market metrics, gold is now freshly emerged into an outperform candidate. And when you break out of some base that's 11 years wide, that's this clear, you're not just going up for a few months. The relative performance is going to smoke for a couple of years, could be. It won't just involve gold doing better than the S&P. We argue it's going to involve both gold going up and the stock market's going down, further exploding that spread. Anyway, this is a situation people need to pay attention to when they think something is over.
Gold is entering a historic phase of institutionalization and market dominance, supported by both long-term technical trends and broader global instability. On a ratio scale, Gold has historically produced eightfold gains in major bull cycles, and analysts suggest that matching past highs could push gold well beyond $8,000. The S&P 500's distortion, dominated by just a handful of tech stocks, further emphasizes gold's relative strength. When measured against broader indices like the Dow or New York Composite, gold has already broken out of an 11-year base, signaling multi-year outperformance. Could this be the moment where gold truly reclaims its status as money? As stock markets reach topping processes and T-bonds falter, monetary metals stand as the primary alternative. This setup suggests sustained upside in gold relative to equities, potentially amplified as global markets recognize its value. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.